Welcome back, friends, to another exciting video. In this video, I'm going to be revealing the most important accounting equation. Before we get started, if you want to email me a question, you can always contact me on my website, revolvesandfinance.com. Boy, am I excited. I have been waiting to do this video. Now, there are a lot of cool equations in accounting, but the one we're going to talk about in this video is the most important accounting equation. And it is so important that all of the financial statements revolve around this equation. Now, I know you're at the edge of your seat, so we're going to start the video off by laying out this equation. And I call this the profit equation. This is revenue minus costs equals profit. Now, you might be saying, really, Zach? Really? This is a really simple equation. Everybody knows this equation. What's the big deal? And I would respond and say, no, they don't. Because if people really understood what this equation is communicating, we wouldn't have half the problems we have in this world. This equation means something very significant. So if you're an accountant, you need to understand the nuance behind this equation and be able to communicate that to your organization. And so in this video, we're going to do a deep dive into what this equation is all about. Let's look at the equation again. Income statements basically follow this pattern. Now, there's a lot more detail on the income statement, but I have simplified it down to its most basic form so we can have this conversation. First, I want to define the terms. Revenue means income or sales. Costs means purchases made by the business, and profit is the result of comparing revenue and costs. Now, in accrual accounting, revenue and costs don't necessarily equal the cash going in and out of your business. And I've made another video on accrual accounting. You should check that out if you want to find out more about that. But I want to just keep this equation simple. So for simplicity's sake, let's just talk about revenue and costs as revenue is your making money and costs is your spending money. So now we need to talk about what is the point of all of this, because this is actually a really amazing thing that's going on here. The point of accounting is to look at an organization and determine its impact on the world. So whether your organization is big or small, you're looking at that organization and trying to understand whether or not it's creating value. So the first thing you do is you look at revenue. Now, every individual on the planet has a certain amount of resources. Now, this might be physical, like land or equipment. It could also be intangible, like knowledge or talent. Each person arranges those resources in their life to produce a result. So a doctor arranges their life to produce medical procedures. A construction worker arranges their life to create buildings. An HR employee arranges their life to perform HR tasks for a company. So each of these people are creating a certain level of value. They create a benefit for society, and all these people get paid according to the value they create. In an organization, you are combining all these individuals in some organized goal. This social network you creates a certain level of value for society. They sell a product or a service, and you can keep building this process upward so you can look at the revenue generated as a region or a country or the world. Then you have to add cost. So any of these organizations is spending money to operate. Each individual in the organization is buying things to achieve their impact. At the overall level, you can add all these purchases up to arrive at your organization's cost. Once we have cost, you can then find out profit. If costs are less than revenue, you produce a profit. If costs are greater than revenue, you produce a loss. What profit is really saying is how much value is created. You spent a certain level of resources and you organized them in a way to create more value than they were originally worth. You brought in revenue that cost you a lower amount. The reverse happens if you generate less revenue than your costs. This creates what we call a loss instead of a profit. In that situation, you are actually destroying value. You are taking resources and turning them into a product or service that people are willing to pay a lower price than the resources were worth originally. My point here is this equation takes an incredibly complex set of interactions and simplifies it into this very simple equation. Profit. That's amazing if you think about it. For example, imagine you have 3 companies that all build computers. A computer company is a very complex organization with hundreds of employees, each doing different tasks and making purchases. This equation lets us roll all that complexity into one simple number, profit, and we can compare the profit of these 3 different companies. 2 are profitable and 1 is generating a loss. Now these companies could be drastically different sizes, so to simplify things, let's imagine they're all roughly the same size. They're very similar companies. Looking at these numbers tells you who is generating value and who is destroying value. Obviously, the first company has figured out a way to build computers that is more effective than the other 2 companies. The company making a loss is actually destroying value. Every computer they build actually costs them more money than people are willing to pay for it. Now, the more you dive into this equation, the more complicated it becomes. A loss is not necessarily bad. This equation is always defined by a specific period of time. So, for example, if you're looking at an income statement, you might be looking at activity and profit over the course of a year. Well, depending on what you're looking at, a year might not be a long enough period of time. You might generate a loss during 1 year, but over a 5-year period, you could be generating a huge profit. So you have to be careful. Sometimes it makes sense to make a big investment to generate profit down the line. A simple example of this is college. So you go to college and it usually costs you a large sum of money, but you're spending that investment to raise your earning potential over a longer period of time. Then let's talk about nonprofit organizations. So nonprofit organizations, by definition, don't make a profit. So what's going on there? The reason why nonprofits exist is because they're usually generating value for the overall community. So they're usually solving a specific social problem that wouldn't show up on anybody's income statement. For instance, a government is nonprofit, and one of the things governments do is they build roads. Now these roads benefit everyone in the community, so it's really the people who are generating the profit here, not the government. The government shows a 0 profit because they have spent the money they were allocated to solve the social problem. Alright, so we've really broken the profit equation down. Now companies are either generating value or they're losing value, and financial statements are written around understanding this equation. But I want to look at the bigger picture because this equation fits into a larger process. The process is activity, metrics, and decision. Each of these things is an action step in a process. So first, organizations are engaged in activities. Then, financial statements are created that describe those activities. And finally, business leaders use metrics to make decisions. What you need to realize is that accountants are responsible for step number 2. So you can't go from step 1 to step 3 without accountants. They're the ones who create the metrics. And so accountants are the ones who are really driving this process in your organization. What I'm trying to say here is that this equation is power. So are you generating profit or are you generating a loss? Are you creating value or are you destroying value? This understanding allows you to look at your organization and understand those areas that you're being most effective in. And if you can focus on those areas of effectiveness, the more value you will create. Now, there's actually a lot more cool stuff going on in this equation, but I'm out of time for this week, so next week we're going to dive even deeper into this equation. Now I want to hear from you. Did this video help you think about the profit equation any differently? Go ahead and leave me your comments down below. Let me know what you think. And if you like this video, if you found it helpful, hit that subscribe button. The best way to supercharge a business is through accounting and corporate finance, and I release a new video every week, so come back and check out next week's video.